To keep you updated on the capital and financial markets, here is a recap of what happened.
Chinese households are scouring for higher-yielding investments as roughly $7 trillion in time deposits come due this year, a shift that could provide additional fuel for the nation's financial markets. The mountain of savings is a legacy of a prolonged real estate crisis and years of lackluster stock returns, which prompted millions to seek the safety of bank deposits. With rates now sliding towards 1%, that capital is increasingly looking for a new home. Investors are weighing a move into stocks, wealth management products or insurance, which would align with Beijing's efforts to cultivate sustainable market gains to support the broader economy. Market sentiment for 2026 among Singapore-based asset managers remains decidedly positive across the Asian landscape, according to a recent survey report. Japan and China were identified as the most promising markets, followed by India, Singapore, and Taiwan, finds the latest IMAS Investment Managers Outlook survey, which annually gathers insights from C-suite professionals across 63 Investment Management Association of Singapore member firms, which include Singapore-based fund managers and asset owners that collectively oversee more than $35 trillion in global assets. Malaysian equities inched higher, while the ringgit was steady after the country's central bank kept its interest rate unchanged, expecting robust growth this year. Elsewhere, currencies appreciated on the day, with the Indonesian rupiah extending gains after the Indonesian central bank held rates and stressed rupiah stabilization efforts on Wednesday, pulling the currency from record low levels. The ringgit was at 4.0420 per US dollar, while Kuala Lumpur stocks advanced 0.6% to within a few points of a 7-year peak. The currency, among Asia's strongest, appreciated nearly 0.5% so far this month after a 9% gain in 2025. Strong economic growth and record-high trade performance last year highlighted Malaysia's strong economic fundamentals, while reducing pressure on the central bank to ease rates any further. European governments are curbing their sales of long-term sovereign bonds as they shift towards shorter-term funding to limit the damage from a rise in borrowing costs. The average maturity of debt sold across big Eurozone markets including Germany, France, and Italy is expected to dip below 10 years for the first time since 2015 this year, according to a Barclays forecast based on government issuance trends. In the UK, the bank expects an average maturity of roughly 8.8 years, the lowest this century. The figures underline how countries' debt managers are responding to waning appetite for long-term debt from traditional buyers such as pension funds. This month, the Netherlands completed a sweeping overhaul of its €1.8 trillion pension system that is expected to sap demand for long-term debt. Economies such as the UK have also experienced shifts away from the defined benefit pension systems that were once almost insatiable buyers of long-dated bonds. Why are leading equity markets staying calm, bullish even, in the face of a cascade of startling policy actions or threats by the Trump administration, affecting everywhere from Venezuela to Greenland and from Iran to Europe? Comments from diverse sources ranging from Wall Street analysts to the International Monetary Fund suggest that markets may be becoming inured to US President Donald Trump's tantrums, in the same way that the global economy has reacted far less sharply than expected to his tariffs. But the one factor that many analysts appear to be overlooking is the fact that equity markets have probably become too big to be allowed to fail. Read the latest issue of the e-Zine available at FIMM's official website to stay updated about what's going on in the industry.
This has been the FIMM TV Weekly Recap. Be informed, stay updated. Be sure to like, share and subscribe.